Okay, so welcome back, everyone, to this second afternoon panel on rescuing capitalism. My name is Philipp Krüger. I'm a professor of responsible finance at the University of Geneva and a senior shareholder at the Swiss Finance Institute. And it's a great pleasure being here and a great privilege to moderate this session. So thanks a lot, Marco, for inviting me. So we have a great lineup. So we have very diverse speakers, and so what the panel is going to center on is further discussions about this concept of shareholder-oriented or shareholder welfare-oriented investors. But before we get to the questions, I would like to ask the three panelists to briefly introduce themselves and their respective institutions to put the discussion into context, and then we'll move on to the discussion questions, and I'll try to bring in the audience as quickly as possible because it's already quite late in the day, and I think that's hopefully you're going to keep everybody vivid and active. So maybe we can start with you, Rupini, and then Catherine, and then afterwards Cas.
Great, thank you, Philip. Hi, everyone. My name is Rupini. I head up the ESG office at Berenberg Wealth and Asset Management. We're actually a private bank based in Germany. Not a lot of people know it. We're actually the second oldest bank in the world. We manage about 50 billion in assets. I head up the ESG office since 2018, which meant I had the privilege of creating our entire strategy from scratch, which meant I also created our proxy voting policy, our stewardship policy. Everything got to do with ESG comes under the purview of the ESG office in Wealth and Asset Management, which means I know the challenges of dealing with proxy voting and from scratch up to the end. Our engagements with companies, I also created our own engagement policy and how we deal with that. So I know everything in terms of cost, how it is in terms of cost-wise, resources, how things work. So I hope to give a practical perspective from that on. Also, just to give an idea, we manage about 20 mutual funds. Of course, now in Europe, we have the Article 8-9 funds. We've got 3 Article 9 funds, and the rest in Article 8. Yeah.
Okay, Catherine.
Thank you, Philip. I do love the notion that we're here to rescue capitalism. It's quite a challenge. And I just wanted to say thank you very much to the ECGI for the invitation, because it's a really wonderful network to get plugged into. I'm Catherine Howarth, the Chief Executive of ShareAction, which is a not-for-profit organisation in the UK that does a wide range of things in the space. We are very active in putting forward a number of shareholder resolutions on ESG themes. We also do research on asset managers, insurers and banks, evaluating and ranking them publicly on their sustainability performance. And we're also really engaged in public policy questions around all of this, which are critical, as everyone knows. I just thought I'd say that I first came across the term corporate governance doing a history degree at Oxford nearly 30 years ago, and reading about Burley and Means, who had written a book in 1932 called The Modern Corporation and Private Property. And it had this really important idea that there was a sort of separation between ownership and control, and that required mechanisms of accountability to help kind of close the gap and make sure that corporate management didn't run off and do crazy things. So whilst we had kind of modern corporations in 1932, we didn't have modern capital markets yet. And in 2022, I think we've got sort of a double agency problem, which, by the way, is very well identified in Oliver's excellent paper, because we have not only corporate management that we want to kind of keep an eye on, but we have institutional investors that take control of all our money, our retirement savings and our savings. And at the moment, they're very free to do, well, they're not entirely free to do what they want, because they're actually kind of guided in law by a shareholder value kind of ideology, which requires them to, on our behalf, focus on profit maximization in most jurisdictions. I mean, there is a bit of sort of wiggle room around this, but as Oliver's paper points out, that might be a problem if it doesn't actually really represent the best interests of the largely disempowered millions and millions of people who every month put money into a retirement account, hoping that the professionals that are looking after it are doing the best possible job on their behalf. So I think we've got a really quite significant double agency problem in modern capital markets and need to fix it. And I really love the notion of shareholder welfare maximization as a sort of pivot that can result in institutional investors doing a better job. I completely agree with the notion that we need to fix fiduciary duties so that we focus on the historic defined principles of loyalty, prudence, and impartiality, and actually almost deregulate in this area so that institutional investors can act in a freer way to pursue the best interests of beneficiaries abiding by those principles and not be constrained as they are in law today, most unfortunately, to a profit maximization outlook, which often undermines the best interests of the beneficiaries and certainly appears not to represent what the views that they have about how companies should behave. So to the extent that this happens, which is all too little, where institutional investors like pension funds have taken the trouble to canvass views, what we find repeatedly, consistently, is very, very strong support for sustainable investment practice, not well represented in practice by the investment strategies and proxy voting approach of their fiduciaries. So that there's a problem, and I'm really looking forward to discussing it in the next hour.
Great. Thanks a lot for these introductory comments. So, Cas, over to you. Short introduction and who you represent and some statements.
Certainly. Cas Sydorowitz, I'm the CEO of Georgeson. My accent gives me away as a New Yorker, but I've been living in London for 20 years, and I'm proud to say that I've just recently been nationalized. So I can say, while I don't have a British passport yet, I have the certificate. Thank you. I'm genuinely pleased by that fact.
Most people are fleeing.
I'm getting nationalized. Fun factoid about myself. Georgeson is a shareholder engagement firm. We help companies identify and engage with the key shareholders. Often some of the same institutions who are here in this room that we've talked about at length, the proxy advisors who influence many of the institutional investors and occasionally retail shareholders. We also work for activists, for shareholders who are trying to initiate change, and so I've worked with or on the same side and opposite side as Catherine on a number of campaigns. And our role is not to persuade investors to take a specific view, but to hold a mirror up to what their actions are going to be and to consolidate that view. Because in many markets around the world, the votes don't come in until the very last moment. And so companies don't necessarily know where they're going to end up from their own engagement with their shareholders, our engagement with those same investors, and the influence of the proxy advisors can be very confusing for companies. We're providing a lens, a shareholder response lens for many of our corporate clients so they understand where they're likely to be and to avoid the surprises at the meeting itself.
Great. So let's now turn it back to sort of the main topic of the panel, which is around this concept of shareholder welfare oriented investors or shareholder welfare maximization as a guiding principle. So maybe to start with Rupini, I guess you represent, you said the 7 oldest private banks, so one could say you're probably like a reflection of a long-term investor, right? You've been around for quite a while. So first question, do you see yourself as such a shareholder welfare-oriented investor? And perhaps you could also share some thoughts on if so, why? Why do you think acting as a shareholder welfare-oriented investor is the right thing to do?
Thanks, Philip. I think that's a very good question to start off. I mean, just to give everyone an idea, we are long-term investors, so we're not hedge funds where we go in and go out. Our whole philosophy and strategy of investing in funds is in for the long term. And I said I had the privilege of creating our policy, also coming from an academic background, which meant I could push our portfolio managers to think in a different way, where it meant to think of long-termism, which meant we just didn't care about shareholder value as a term in terms of risk at that moment, but welfare as a term. I did not coin this, Professor did coin this term of 2018, I called it finance with a heart, a bit of a different, easier term, which I push forward for our portfolio managers. So for us, investing in shareholder proposals that could potentially be, we had this conversation before, that could potentially be a risk for the company, but for us, because we're long-term investors, we see ESG as a risk. We started it in 2018 as an ESG integration, is a risk perspective. So for us, it makes sense to invest in a perspective where, in the long term, if the company needs to have that change, and if it doesn't create that change, and we vote against the board, or we support shareholder proposals where they don't change, then for us, we understand that risk, and if there's a risk in the company, we get out of it. But of course that comes together with engagement and going forward. So for us, from the start on, our philosophy is that we didn't coin the term shareholder wealth, but it was more about it just had to be right. So that is for us. It's long term, it's risk, and where we can see the company going.
Can I ask Rupini a question?
Yeah, sure. I was about to ask you a question, but if you want to respond or like...
I just wanted to ask something specifically to what you said. So you talk about you can get out. So I presume that means you would sell your holdings of this.
After a long time. Yeah, correct. So it's not an immediate decision. So we have, as I said, we created an engagement policy which involves proxy voting. We would do collaboration. And only after a long time when we think, there's that risk, and we really see that risk, we will get out. We will get out after a while, but in the short term, we will still try to see as much. So just to give everyone an idea, we also invest a lot in small mid-caps. We call them Mittelstand in Germany, and that's where we see we could actually have a voice and try and push. For example, when it comes to board remunerations, and I talked about this someone earlier, for example, if their TSR or something is not incorporated, we go up and say, listen, please have that in. If you're not in next year, I'd vote against. If not, we would probably, in 2 or 3 years, if this doesn't change, we will go out. And I've had these conversations with portfolio managers. Initially, it was, why do we need to do this? But again, it's that whole cultural mindset. And I said, I had the privilege of creating our ESG policy, which meant all my policy decisions are together with our portfolio managers. We have kind of like a house view which we created together, and that's what we do in the end. Yeah.
Have you ever submitted shareholder resolutions yourself?
No. So we do support some. For example, with Catherine, we had one for Unilever where we support their shareholder proposals because not in the US, so we don't have a lot of holdings. I mean, again, we are small. We're not the BlackRocks of the world, so we don't have the capacity to do that.
Not that they do it.
Not that ever.
Yeah, but maybe so if I understand correctly, so you say you are such a shareholder welfare-oriented investor, and if I understand correctly as well, you do the implementation not only through voting but also through engagement, in particular with smaller firms and potentially divestment. But I'd like to ask you, Cas, now. I mean, you speak to a lot of different shareholders to different companies, and sort of one thing I'm intrigued about is here we have a concrete example of such a shareholder welfare-oriented investor. But sort of how systematic is that really? How broad of a support among various types of shareholders and institutional investors do you really get to support actions or proposals that are potentially shareholder value reducing, right? I mean, I'd be interested in getting sort of a broader view from you on that.
Sure. In Europe last year, I think there were 5 or 6 ESG specific resolutions. This year there were 7, and the overall support between 21 and 22 for those companies where there was overlap was actually a decrease. Now, part of that had to do with the fact, and we've heard mentioned earlier today, they were targeting oil and gas companies. Those same companies had record earnings. So because of the energy crisis, the price of oil.
So that's Europe, right? But we also saw some statistics earlier today, you know, where Oliver Hart presented sort of that there was like increasing support also for these, like first of all, an increasing number of these ES and ENS related shareholder proposals, and also increasing support. But then again, you know, these ES proposals that were shown, you know, they might not all have been, you know, value reducing. There might have been certain ones, you know, maybe the ones Rupini also referred to that, you know, are win-win. There might have been neutral ones and sort of shareholder value reducing ones. So in the US, like, you know, like do you see like more and more investors really, you know, voting in favor of these value reducing ENS proposals and getting, you know, into that shareholder welfare oriented mindset?
So I have to admit this is a pessimistic view. In the United States, I see it going the opposite direction. I see far fewer investors kind of taking up that mantle and willing, regrettably, taking up the responsibility of taking a longer-term view that may have an impact on short-term profits. And also in the United States, you don't have as many NGO resolutions as you certainly do in a European basis. You have gadflies and, you know, pension funds and, you know, lots of other different shareholder proponents in the United States, which aren't as active or as prominent in Europe as they are in the States. You saw one scenario this year here in Belgium with Solvay, with Bluebell Partners. It was kind of a remarkable situation. Bluebell only had one share, and they put pressure on the company. I think what's relevant for everyone here is that, you know, the way to have an impact, and clearly their weight was not in their shareholding. One share did not represent anything significant, but their engagement with politicians, clients, customers, regulators, both in the local and an EU level, really brought down a significant enough pressure on the company, and they ultimately made some very important concessions. And there was engagement that, you know, I think they even issued a joint press release earlier September this year.
To briefly to you, Catherine, I mean, you had a very multifaceted organization, if I may say. You know, you're on the one hand sort of a policy group, but also of an activist as well, right? I mean, you shape investor coalitions.
A gadfly, I think is the term.
And a gadfly. I mean, I didn't want to use that term, but
sure.
You know, let's you know, if you had to put on, you know, your hat of sort of like an NGO type institution, you know, like as you saw in the US, that really, you know, mobilizes these multi-stakeholder coalitions for engagement. Let's say in the broader question of stakeholder-oriented capitalism or shareholder welfare-oriented investors, where do you see, you know, NGOs and you fit in, like, you know, in promoting that type of behavior?
Well, for the time being, organizations like mine occupy a very important space because for the time being, until such point as institutional investors are empowered, challenged and motivated to do what they ought to do, which is to really engage proactively on an agenda that represents the full welfare of their end investors and beneficiaries, it's left, bizarrely, to gadflies like us to, you know, help kind of open spaces and kind of begin to socialize areas which very promisingly investors are really engaged to move into. So let me give you an example of a theme which I think is neglected in ESG but fundamentally important to this concept of shareholder welfare, which is public health. So everyone's engaged with the fact that corporates have an impact on planetary health through emissions and through other environmental damage, whilst also, of course, there's a whole suite of companies that are, thank goodness, being very commercial about providing solutions to environmental damage. That's a really fantastic bit of capitalism, and it needs further investment. But the whole many companies in our pension schemes operate in ways that are damaging to our health. So, you know, when we retire in our old age, the thing that will really influence our quality of life is the two things will be our income and our health. So if along a kind of 40, 50-year pension fund investing journey, you've built up a pot, but unfortunately your health was undermined because it was invested in, and collectively everyone with retirement savings was invested in companies that were, you know, providing goods and services which were really damaging to health. And this is, you know, I mean, then you know, your net benefit hasn't really been so good. And yet, of course, in law, many institutional investors feel frightened to engage with the issue of public health because they think it's off limits and, ooh, what? It might reduce shareholder return. But what's very interesting to observe is that there are more and more investors who, despite the constraints of the law, recognize the overwhelming logic of this. So we filed a shareholder resolution earlier this year at Unilever. Unilever is a company which actually many consider to be a sort of sustainability poster child because they've always branded themselves as tremendously good on sustainability. Every single day, 3 billion people on the planet put a Unilever product in their mouth. You know, they have a huge impact on all of us. We probably ate something from Unilever today, one way or another. And a lot of it is sugar. And sugar is reducing people's life expectancy at scale in a big way. So how do you triangulate that as a pension fund? So I think there's a role for organizations like us in opening up spaces like that and debates. It's happening in the US, it's happening in Europe. It's exciting, but the big constraint on it, in my view, is the current legal position. Because even though you've got, and I talk to them all the time, fiduciaries sitting on pension fund boards who are totally intellectually convinced by this, but they're also frightened that the law doesn't allow them to go there. So I think we've got a kind of conundrum, and you know, I suppose an organisation like mine and others like ShareAction are kind of filling a space. It's not a very satisfactory situation, I think, but we are filling a little space for the time being in bringing forward ideas which really bring to life this really fantastic concept of shareholder welfare.
Maybe now let's talk a bit more about the hurdles and challenges, right? I mean, Catherine, you kind of already mentioned the constraints of like fiduciary duty as they are defined today, and you even advocated for deregulation, right? Kind of freeing the pension funds from these regulations. But if we think more practically now, in terms of getting a coalition of shareholders to vote, for instance, in favor of a proposal that reduces the sugar content in Coca-Cola, or like taking maybe Cas, I mean you work on this. How is this possible? When you have maybe two sets of investors, one is just simply shareholder value oriented. They say no, we don't want to do this because in the short term, we're going to make more profits. And on the other hand, you have like more shareholder welfare oriented investors who think about not only the monetary benefits, but also perhaps the world in which the retirees are going to retire. And like how can you ensure that you get support for such shareholder value reducing proposals potentially, right?
Sure. It's a number of things. It's understanding who the shareholders are and kind of modeling them once you have that basic list. Understanding which investors are very dependent on an ISS or a Glass-Lewis recommendation, which investors have their own policies and are looking at things on an independent basis and are not influenced by those proxy advisors, and then starting an outreach campaign. And we have talked today about State Street, BlackRock, and Vanguard. There are no fund managers necessarily at those asset managers. They're index followers to the largest. BlackRock is for a large part of their portfolio, but they all have very extensive governance and engagement teams. BlackRock is something like 60 individuals in their engagement team around the world, in London, in Asia, in the US. And so understanding who to engage with and how to engage with them is very important. The challenge that we face for some of our clients, or even some of the activists, is getting time with those individuals. Because, while we heard Corinne say at Norges, they're voting at something like 11,000 meetings over the course of the year. BlackRock votes at 17,000 meetings a year. If there's 250 working days a year, that's 61 meetings a day. If it's evenly spread out, and we all know they're not evenly spread out. So on some days, they're voting on 200, 300 meetings a day. They don't physically have the time to engage with all the companies or activists who want to engage with them. That's a real challenge, because if they vote a certain way without engagement, are they missing an opportunity to learn something either from the company or from the shareholder?
Maybe before we go to Catherine, because I think do you want to respond quickly? Because
I can do so later.
Okay, so Rupini, maybe to you in terms of hurdles and challenges, how would you deal with, let's say you face a very specific shareholder resolution you're supposed to vote on, where you clearly know it's going to be shareholder value reducing. How you as a fiduciary, how would you deal with that?
I mean, that's a very good question. For us, we don't actually think about it that way. I mean, the ESG office, we vote basically, we have our policies, it's very set. We use one of the two providers to provide us with the analysis, but we have our own engagement, we have our own, we really dig deep. End of the day, it's for the benefit of the society is what we think about it. And that's how we think shareholder proposals are. We don't actually think if it's value maximizing or so forth. It's end of the day, does it make sense? For example, the Unilever one, which we supported, did it make sense for us as a society as a whole? Did it make sense for Unilever to come up with more disclosures? Yes, yes, and yes. So that's how we vote, because when we vote, when I talk to my portfolio managers, the conversations are not, if we voted in this way, the stock price might go up by 3% tomorrow. It's really not that. And maybe it's different with us because we really have this very tight working way with the portfolio manager. So maybe that concept is very different, that we are able to discuss with them where we think companies should be going and so forth. So maybe our way of working is very different.
So maybe it's also this combination of already having this dual objective, and in particular being a very long-term oriented investor.
Exactly. So there's never really this conversation of, if we voted this way, oh my God, there's going to be a problem. It's really more, if you don't vote this way, what's going to happen to the company? There's no disclosure. That's a risk. We need to know. We need to get more information. And that's how we think.
Okay.
As I said, maybe it's a privilege that I got to create the policy and spin it a way that pushes ESG, because it's really part of my blood. And I've been in this for a while. So it could be that's the reason.
Catherine, now to you. I think you wanted to respond as well, but maybe also, not only, you mentioned some challenges already, like the system, the fiduciary requirements, but maybe, also what could be done, concretely to, promote this shareholder welfare-oriented view.
Well, one of the things I wanted to respond to was, but I think it does relate to this discussion, is the fact that BlackRock has 60 people doing stewardship.
We have 3.
I mean, I just want to put in perspective. So BlackRock obviously is an index tracking firm, and so it can't do buying and selling as the way of protecting investors. All it can do is stewardship, voting and engagement. That's for an index tracker. That's kind of how you manage risk, unless you, of course, tilt and design indexes in new ways, which is obviously a very important trend. But I would contend that a barrier to this all taking off is that the business model of firms in this space does not actually incentivize stewardship. I mean, 60 people at a firm the size of BlackRock, with the responsibilities that BlackRock has got. I run an organization with 80 people. It is pitiful. It is a tiny fraction of the marketing personnel at a firm like BlackRock. It is not acceptable. But institutional investors, pension funds, give them mandates on the basis that they're charging the least. Because over at the asset owner side of the fence, it's like, our obligation is to manage cost. That's when we're doing our duty. So we'll go for the lowest cost index provider actually underinvests heavily in an incredibly important service to protect the long-term interests of the underlying investors, underinvest in it heavily, and then also kind of add insult to injury in a sense, has also, in the case of BlackRock, got completely scared off in the last proxy season and is no longer willing to even use the voting power it's got. So I just think this system isn't working for people who put money to work in the system. And so I think that there's a business model problem in capital markets, and then there's also a legal constraint as well.
Okay.
But I think all of those things could be unlocked. I'm perfectly positive that solutions can be found, solutions need to be found, and will be.
Cas, over to you. I mean, like you work a lot in the space of shareholder engagement and all sorts. So what way can you see, like, levers or potential for improvements and,
So I just want to respond to your comment. While BlackRock may have 60 people, Vanguard and State Street have a fraction of that number.
Okay.
And
Yeah.
they're
Even worse, right?
the second and third largest asset managers in the world. So the fact that some of these very significant investors have so few resources is quite shocking. The way companies kind of address this most effectively that we've seen is doing two things. One is kind of drawing the connection of their social, of their purpose, not their social, the company's purpose, and how identifying the material risks, the environmental and social risks, and drawing a connection between those two. And then secondly is best-in-class engagement. So in terms of being able to identify their shareholders, have a discussion with those investors, the governance teams, to understand and listen and be engaged in a dialogue, not just telling them something, I think is all important. Because if you bring your shareholders along that journey and engage with them early on, that you will find out that either you're directionally wrong or that you may have the buy-in and support of your investor community.
Yeah. Okay, so something I hear is that probably these large investors, they do not dedicate enough resources to this whole engagement process. But then in the discussions we had before this panel, Cas, you mentioned like sort of a recent development, these ESG Activist Funds, right? I think that's something rather recent. Whereas with activism, typically we associate kind of like the hedge funds that push for restructurings and like asset sales and etc. But now apparently there's like a new breed of ESG oriented activists. Could you talk a bit more about that, and maybe also where that fits into this whole debate on stakeholder or shareholder welfare oriented
Of
investing?
course. We already heard discussed this morning Engine Number 1 and their campaign at Exxon. Their ETF is called Vote, because their structure is we want to encourage those who invest in that ETF. They're confirming to them that they will vote on the portfolio holdings in that ETF. But unlike BlackRock, one, they don't have the assets under management that they do, and the portfolio size is very limited. So while they do vote, the number of companies they have to vote on is quite limited. In Europe, you have a number of ESG activists who are defining themselves either as ESG activists or impact investors. I mentioned one, Bluebell Partners. Their campaign at Solvay was kind of a pro bono activity that they described. I saw Marco this week in New York, and he said, we did this as a pro bono. We did it on the weekends and at nights. I'm not so sure that that's exactly how they ran it, but and Clearway Capital is another small Frankfurt-based ESG activist who is looking at these specific issues. There's more in the US, but for the vast majority of this asset class, there hasn't been a huge influx of money. If we did, if these funds and others started getting huge influx of funds from asset allocators, from pension funds, endowments, and others, we'd see more of them popping up. We're just not seeing that. Now, maybe that's to come, but they've both been around. Clearway and Bluebell have been around for, Bluebell for a year and a half, I think Clearway for 9 months, so.
Okay. So maybe it's time to open up for questions from the audience. Yeah, Tom, please.
Thanks very much. Tom Gosling, London Business School. I've just got a question about if we go down this approach of shareholder welfare, how investors can think about kind of costs and benefits when they're interacting with beneficiaries, because I think we need to assume that this isn't always going to be a win-win. And if you take the sugar example, it's probably going to cost the company money to have less sugar in, because maybe it's going to be less attractive. Maybe they can figure it out, but some of these things are going to cost money. And so then you've got to figure out, well, what's the return from a welfare point of view to the investor? And I might kind of get a nice feeling if I'm helping people eat more healthily, but actually if I don't consume sugar myself, that might be a benefit that's going elsewhere. I mean, at some point we've got to think about costs and benefits of this action if we're going to take a shareholder welfare approach. So how do you think about trading that off when you're deciding what actions to compete on or not? And I'm happy for anybody to comment on that.
Ask the end investors. They are the silent majority in all of this. Like they don't get asked. There's no obligation to canvass their views. That's beginning to happen, which is excellent at a retail investor level, at EU level. There's now kind of more requirements coming in that invite investors to sort of set out some of their, retail investors set up some of their sustainability preferences, not so much their engagement preferences, which would be interesting. But at the pension fund level, we've drawn up some model legislation which we think would put in place effectively an investor governance regime, which I think draws inspiration from corporate governance thinking over many decades, but recognizes that there's a double agency problem in modern capital markets, and that end investors should be, in a manageable way, canvassed. And after all, we've got loads of digital tools we could use for this purpose. I'm not at all in favor of, some kind of chaotic, anarchic system where people feed into every vote. I think that's entirely impractical. I think on a periodic basis, there should be canvassing of opinion. And by the way, I'm beginning to see it happen, which is wonderful. So Railways pension scheme in the UK, Nest, a growing number of pension schemes are acknowledging that they invest someone else's money, and maybe they should do the courtesy from time to time of asking them their views on things that would
I guess the
really
point about
material
asking
to them.
views is that it also has to get a little bit beyond asking views around kind of informed consent around the magnitude of the trade-off. I mean, that's what's quite challenging.
So I think the bigger point that's being raised here is sort of, how do you measure success in the context of, shareholder welfare-oriented investing, right? I mean, I guess it's relatively simple, well, perhaps not, but let's say from my academic, perspective, it's relatively simple, to calculate investment success. But how can we then, if we have this concept of shareholder welfare-oriented investing, how do we quantify, the success that is being made? I guess that's where you're getting at. No, how do we calculate whether and investors actually pursuing that objective effectively, right? I mean, instead of if there's any objective, maybe we're going to get a world where anything goes, right? Where we have multiple objectives, and I guess this question of measuring success is an important one, and I guess it does include issues such as cost and benefits, right? For all stakeholders, really, which stakeholders should one include in the analysis? I'd be interested in how we can measure this success.
Shall I have a go at that?
Yeah, I think
Since
you would
I
be the
seem to
right
be,
person. Yeah.
So I've been thinking about this, and I've been reflecting on, because I used to serve for 5 years on the board of a large pension scheme, and how do I know if I was successful in that endeavour? I mean, for a start, I'm investing assets that people won't draw until decades out. So I'm long gone anyway, and that's always the case inside capital markets. By the time someone actually gets to enjoy the fruits of my successful investment strategy as a board. So I think the counterfactual is, can we really measure success of conventional investment strategies? And I question whether we're brilliant at that at the moment over the long term, because day in and day out, decisions are being made which could have been different decisions. I mean, we've just seen the LDI debacle in the UK play out, kind of interesting. That was a really popular new risk management pension fund strategy. That one went really well. Is anyone going to be held accountable for that in the pension fund industry? I very much doubt it. That's not the way it works. And in a way, it can't work like that. It's always the best endeavours. And my point really is that the best endeavours should take a broader perspective on the actual long-term outcomes and welfare of the beneficiaries. That should involve a process of canvassing their views, and probably has to be along the lines of some kind of majority opinion amongst beneficiaries. And there will always need to be some weighing up, because one of the things I love about today's conversation has been this honesty on the fact that there could be some trade-offs. Yes, there could be some trade-offs, but it could still be net-net the best thing for beneficiaries to not optimise financial return, but to optimise for other welfare-enabling outcomes. But it's going to be a tricky job to measure outcomes. So I think we have to get into the business of measuring process and the integrity of process, and whether people could hold accountable the people that made decisions on their behalf. I am a big fan, totally got blue sky thinking, I'm a big fan of pension funds having annual general meetings so that the beneficiaries can turn up and ask a few questions and ask how the strategy's going. Because by the time you draw your pension, it's definitely too late if people got it wrong. But it would be nice if at least along the way you could ask a few questions.
I think it also has to do with the time horizon. You said it, but it's a matter of if you're measuring success on a quarter-by-quarter basis or even 6-monthly basis, that's probably the wrong metric to measure it on. And if we start to, part of this is education, part of this is how you define success, and if you start talking about 3-5-year time horizons as opposed to 3 months, 6 months time horizons, that I think we'll perhaps have a different perspective on what success equals.
I mean, if you don't mind if I just add on, in our engagement policy, we have milestones where we call that a success. So when we engage with a company, it's really, do they acknowledge it? First line of success. Do they not acknowledge it? Okay, they're disconnected. In a way, I call them disconnected in my team. But it's because we're so small. Any feedback that we get is success to us. Any change that they want to do because of our recommendation is a huge success for us. So that's how we review our success. It's really the small changes. And we know, and I put this as a caveat, it's really for the smaller companies. That's why we work with ShareAction and other groups in collaborative essence, because we know we can't change the big ones where we come in with just a 0.0001% of a holding. But with the small mid-cap companies, we do have large holdings in Germany, and that's where we actually have huge successes. I can actually give an example. It was just last year where we actually went to the board and said their remuneration policy or their report was not sufficient enough, it wasn't great enough. We actually said, if you don't change, we would vote against anyway now, but we could even divest. We talked about this earlier, and they freaked out a little bit. Okay. Because we do
that
have...
That also answers like one of the questions here. Catherine, really quickly, because there was another really quickly, and then we'll take
just
another
really quick,
question.
just say that a very positive development in the UK is that the UK Stewardship Code, which came in a couple of years ago, has this emphasis on stewardship outcomes, which I think is an excellent development, and is putting investors to the test as far as, okay, show us how this is managing risk and delivering outcomes, which I think is great. So that people are really taking seriously the process of establishing efficacy of this, which is good.
Well, that's good. So there was a question up there, yeah, please.
Thanks. Deborah,
could you speak up? Sorry,
Okay, yeah, I want to make sure that everybody hears my question this time. We've talked a lot about shareholders today and the different tools that they use, but we should also talk about the role of companies in rescuing capitalism, because sometimes companies just don't respond to shareholder engagement, to shareholder voting. Rupini just mentioned remuneration. It was great to hear a success, because for remuneration, there's lots of examples where shareholders have exercised their voting and their engagement and voted down advisory votes on remuneration, and the outcome is that nothing changes. The CEO still walks away with a bonus that shareholders didn't approve of, for example. And that outcome for the end saver investor isn't a good outcome either. So I'd be interested from the views of perhaps Cas, when you work with boards, what decisions do they make when they get a 70% vote against from their shareholder base, and the outcome is we'll have more conversations and we'll have more engagement with shareholders? there has to be something different than that, I think.
So I would just say that there's a lot of companies that kind of are satisfied with a 50, 60, 70% support rate, perhaps aren't using proxy solicitors, us or others. So I think, that tone deafness is, they're not necessarily reaching out to the investors, doing that engagement on their own. For companies that we do work for and they just eke by with 80% or 79.6, they take it as a slap in the face and they take it very seriously. It doesn't change their behaviors necessarily always. Hopefully the good ones that we work for listen to their shareholders. I can tell you that there are many corporates who, for the investors in the room, if you write a letter to a company and you don't get a response, you should just ask whether or not they even got the letter that you sent them. Sometimes they did and they chose not to respond. I mean, that to me is ludicrous. But you have companies at all ends of the spectrum. So the first thing I always ask clients is, has any investors written to you and explaining why they voted the way they did? Because that's where you want to start. Those are people who've reached out and given you a line into them. And then we can go down the rest of the list. Unfortunately, there are just some who are tone deaf.
The Church of England Pensions Board is doing some work actually that I'm helping them with, look at the governance and oversight of remuneration, because it is an issue that causes a lot of tension across all types of stakeholders. And we've talked a lot about other issues today, including climate risk and social and environmental issues, but we shouldn't forget that the governance of executive remuneration is a persistent issue that causes a lot of tension between shareholders and companies and other stakeholders as well.
Are there other questions in the audience? Yeah, please.
Yes, thank you. Isn't it correct that as large diversified investors will normally have, or will have the outcomes of their welfare be measured by beta, the outcomes of the full economy, and not individual alpha of companies? And if that's true, I think it is. That's at least the way I understand what some of the new corporate governance is saying. Isn't it the case that if we had better measures of GDP, quote, and better accounting systems that actually accurately incorporated the social and environmental costs of externalities, then couldn't our simpler measures of financial outcomes actually be more parallel to a measure of shareholder welfare? Sorry, that's kind of complicated.
It's a complex question.
That's the kind of question my students don't like.
Yes.
Well, that's at least we agree. Any other questions? Maybe yes, please.
So you want to prevent me from speaking, but no chance for that. So if I recall the academic debate correctly in the United States, one concern with broadening up the corporate objective function and reducing the traction that you can get out of fiduciary duties is that you're reducing managerial accountability. So giving a broader mandate simply means that they can do whatever you want. And if you connect it to the previous panel, what we learned there is managers are taking care of these things anyway. And isn't it something that doesn't have so much traction in the European context, where shareholder litigation historically didn't play a big role in holding managers accountable? And isn't that a chance to develop a system which runs a little bit along the lines that you already discussed on measuring outcomes, that is away from courts, away from hard facts you're delivering or not, and something that's more aligned with a broader objective function of the firm? Is that a chance? Do you see that?
Yes. Yeah. I mean, I think maybe if we had a longer time, I mean, it's not so easy, but I think that should be the case. That should how it should be. But yes, short answer, yes.
I would just add to that. In the United States, the end beneficiaries, the underlying investors behind brokers, have been enfranchised for many, many years, for decades. In Europe, that's just starting to come into place now as a result of the Shareholder Rights Directive 2. And so you had huge communities in the UK and in Europe who were never notified or given the opportunity to vote. If you were a shareholder and you held shares at a bank and you were informed about a meeting because you read the newspaper or there was a headline that you got interested in and pursued it, you could call your bank and pursue them to try to exercise the vote on your behalf. But you weren't sent materials. You weren't given the ability to vote. And don't forget, in the United States, you can vote via paper, you can vote via the phone, you can vote over the internet. So we're just starting this process, at least in the UK and in many European markets, where they're giving the voice to the underlying beneficiaries.
I mean, if I could just add on that. So we vote for our funds, and that's confirmed. So we have mandates, special mandates for small clients where legally they give us the right to vote for them. What I'm trying to do now is exactly what Cas said. It's actually go to the clients now and say, listen, you have the right, we have our policy. Would you like to vote in a different way? So we're starting that. But again, it's a resource issue, it's a cost issue. Per company, per analysis, there's a cost to that, which it's not been talked about here. So small asset managers like us have to think about that. Does it make sense? Do we want to go in that way? Do we want to offer this offering to our private clients who have special mandates, who have the option of voting?
And how much will you charge them?
Separately. But, so these are things that we push because we know, as I said, I've had the opportunity of building this for the last 5 years, so we know the challenges. Now we have a setup that we think we can scale it. So we're trying to push that as well. And it takes time, it takes effort. It was a huge learning curve, but we're trying to get there, trying to push this on.
I was just trying to connect to the last panel where there was a very interesting discussion about companies and how companies are the solution to all this. And of course, that's true in many cases. Some companies are brilliant and enlightened and they're innovating and they're delivering and developing solutions to real problems in the world. But of course, there are also some bad companies that are intransigent and unaccountable. And that's why we have a corporate governance regime, so that you can kind of push and you've got rights and you can kind of ultimately get rid of directors of companies where things are not going well. And similarly, institutional investors, there's some wonderful, wonderful, brilliant, enlightened and smart institutional investors doing amazing things within the constraints of the law. And I think, actually pushing against the constraints of the law at some risk sometimes to themselves, but because they really want to do interesting things. And then there are institutional investors that, rather like in the corporate sector, that are unaccountable and less engaged, honestly. And there are conflicts of interest, and there's lots of opportunities in capital markets for people that work in the system to benefit off the backs of and paid for by the underlying investors. And so in all of these systems, we need checks and balances. It's just sort of very obvious principle, I think. And I think that they're not, as Deborah says, they're not working perfectly in corporate space. But I suppose my general point in this panel is that they're working even less well at that next level up in the capital markets, where I think things are really underdeveloped still, and there's a lot of scope to make capitalism really work much better for people.
But that's sort of a bit of a pessimistic tone then as well, right? That you're saying that, or is it optimistic that shareholders actually can rescue capitalism and make up for these deficiencies?
I think capitalism needs to work for people. Otherwise, there's no point in having it. And it works well in places and less well in others. And the whole point of, I guess, ECGI is thinking, how do we tinker, how do we experiment, and how do we evolve the system to work better? And I see a lot of scope for actually very manageable and achievable reforms that would make it work a lot better for most people.
Okay. So I think we're out of time, unless Cas and Rupini, do you want to make some last statements maybe before we move on to the next panel?
I'll let you go.
Oh, wow. I think we need more then. But I know we ended in a pessimistic tone, but from my end, I can just say that engagements at times does work, as I say, with smaller companies. So please don't be pessimistic. There is a way forward, especially, and voting has a huge option and say. So strengthen it.
I'll leave on the
Okay, great. So thanks a lot for this lively discussion. Let's hand it over to the last panel on policy conclusions. Thanks.